The Art of the Uncertainty. Hi, Dean Jenkins with FollowMeTrades.com, and this is the market update for the week coming up of April 9th, 2018. And I'm showing the S&P 500 chart, and we have definitely had some volatility really for the last couple months and continuing through last week. And I say the art of the uncertainty. Of course, I'm making a reference to Donald Trump's book, The Art of the Deal, and the fact that the president's deal-making and negotiating tactics have introduced the one thing that markets do not like, and that is uncertainty. So whether the negotiating tactics will work in the long time, whether that's good or not, that's a discussion for another forum. But the uncertainty has been introduced. The market really does not like it, and we can see the response to that. We've got a pretty interesting pattern here, and I want to go ahead and point it out real quick. You can see using Dow theory that after the market was on a tear. Really, after the election, it went parabolic, and before that, for 9 years, an unbroken bull market. Really impressive. And here at the top, we've had this classic Dow pattern where we had a low, and then a lower high, and a new low. And as we put in this new low, this white line is a 200 simple moving average, and we broke through that, actually closed below it, and that's significant. The last time it even nipped below it just a little bit was back in 2016. So we're below the Ichimoku cloud, which is also predictive resistance and or support area. We got down below it, and the probability is this will now become resistance, where once it supported price didn't go down through it. Now that it has, and we've got this dramatic move, that will probably be a level it doesn't get above in a meaningful way. And the Ichimoku cloud is predicting a downtrend, and according to Dow theory rules, we are in a downtrend and the beginning of probably a larger correction. Now it can pull back up to the cloud before heading down. Things don't move in straight lines. The next moves could be lower lows, lower highs, lower lows, but it does look like the larger correction has begun. And let's get a bigger context on that. So I'm now showing this S&P 500 on a weekly chart. I was on a daily chart before. So this is a much bigger picture, and you can see, this 9-year bull market we've been in, and clearly something a little bit different going on now than has been going on for the last couple years, and starting to pull down. And if you compare this price action, what this looks like right now, back to when the correction began in 2007, it was very similar. We had a bit of a warning, then a pull up, and then the move began again, lower lows, lower highs. And again, it doesn't move in a straight line. The market goes in a downtrend, lower lows, lower highs, lower lows, lower highs, uptrends, higher highs, higher lows. So it does look like on both a daily chart and a weekly chart that it's changing, and there's a pretty good chance that we're entering a larger correction. And on a weekly chart, the correction zone for the S&P 500 is between these two blue lines. These are Fibonacci retracement lines, and that range is 2120 down to 1639. So a pretty good down move, likely to be starting, not certain, but again, the signs on the daily chart that I was showing earlier, and I can switch back to that, pointing to it beginning. Another definitive break of this 200. If we get solid closes down 2575 on the S&P 500, the probability of that larger correction gets higher and higher. I want to show some other interesting information. This is the Shiller PE ratio for the S&P 500. Now, I'm a technical trader. I don't lean too heavily on fundamentals, but it's interesting to look at it in terms of historical patterns. And you can see we're at a very high price to earnings ratio on the S&P 500 according to Shiller's method, which is different than the standard price to earnings ratio. I think it's actually better. And you can see the mean over all history is 16.84, median 16.15. The max that's ever been is 44.19, and we're pushing somewhat close to that. We're just about double the mean, and you can see back in 2000 when that correction happened, it was at a pretty unprecedented high level, and we're above any kind of recent highs. for the PE, the price to earnings ratio, using Shiller's method. And high PE ratios have traditionally predicted the beginning of corrections. So again, I don't lean too heavily on fundamentals. I take my cues off technicals, but it's not a bad thing to keep an eye on and see if there's some correlation there, and there certainly is. So I'm trading very cautiously. Again, if we get a good solid close down below the 200 here on the S&P, I think things are going to get clear, and I'll be trading more aggressively to the downside, taking shorts on individual stocks and ETFs that have individual good setups. I'll be careful not to correlate the trades and be taking basically the same trade over and over. And I'll be looking at taking longs on flight to safety kind of instruments, metals, commodities, other things like that. And let's go ahead and take a look at gold and oil as we normally do. So here's the gold futures chart, and gold has been challenging. It is in an uptrend. It was in a pretty ragged uptrend through 2017. It's been consolidating for the last few months. Typically, historically, when the markets start to go down, gold goes up. It's not a perfect correlation, and I would not trade based on simply a reasonably strong historical correlation, but I'll look for a good strong setup. But I'm watching for it and expecting it. But I don't trade based on what I expect to do. I trade based on what is actually happening. And when we get clear technical signs of gold heading up, then I'll be trading it. Several people have asked me recently about silver, and silver currently is in a downtrend. If you look at the big picture here, it's putting in lows, it's heading down. You can see the 200 moving average heading down. Now, if it turns up, there may be more gains to be made in silver, and we'll be watching that closely. We would expect it to go up, but again, we don't trade based on expectations. We trade based on the realities of what's actually happening. So we'll continue to watch that, and there may be potential there. These things take weeks and months to play out, not hours and days. I'm not day trading. I'm taking position trades, typically in them 4 to 6 weeks long. So let's go ahead and look at oil, crude oil. So crude oil is in an uptrend. It had a big impulsive move here. It corrected nicely into a Fibonacci retracement zone, headed up, pulled back the last couple of weeks, but this is higher highs, higher lows, higher highs, higher lows. Looks like it's hitting the Ichimoku cloud now. Expect, again, I don't trade based on expectations, but expect and be watching for a reversal and then another leg up. And once that happens and we get the clear entry signs, I'll be looking at a long on oil. And that could take us up above $70 a barrel, which sounds, wow, really? But that's what the technical signs show. And again, I'll trade based on the reality of what's actually happening, not what we expect to happen. Let's go ahead and close back up with a recap on the S&P 500. Again, looks like a correction beginning. We'll get clearer evidence of that if we get a good solid close below the 200, and I will begin trading fairly aggressively on individual trades and maybe even the SPY itself. So that's it. Wrap for this week. Certainly is uncertainty, and probably will continue, and the markets will continue to react. And given, I showed the high PE ratio and the end of a 9-year bull market, participants are looking, and reacting pretty strongly to any kind of news. And it's hard to conceive of really good news at this point that would drive the market higher. That after this run, given the historical nature of the historic and cyclical nature of the market, participants seem to be looking for reasons to precipitate the beginning of the larger correction. So that's what I'm biased toward watching for, but again, trading the realities of what's actually happening. All right, take care. As always, leave your comments, your questions. Love to hear from you. I respond to every single one, and we'll catch you on the next update. Trade safe, use risk control, keep your winners big and your losers small. Thanks.